They say hindsight is 20/20, but sometimes it's much clearer in hindsight just how blind we really were. It was 2018 and the world was on fire. In Europe, tensions were rising over a 5-year-old conflict. In America, a polarized election loomed, and in the background, a global disaster was brewing, but Wall Street didn't care. Not a war, not a crash, not a pandemic, just an opportunity. An opportunity presented by a company you may have heard of, Wirecard. Wirecard was a payment company based in Germany. You may not have heard of them because their business wasn't exactly glamorous. They processed online payments for merchants. Think eBay or Amazon. But unlike those giants, Wirecard was focused on riskier clients. Gambling sites, porn sites, high-risk credit cards. These were Wirecard's bread and butter. Most of their revenue came from transaction fees. The riskier the client, the higher the fee. And to serve these clients, Wirecard had a unique sales pitch. For years, they offered cash advances to their customers, basically a loan against future earnings. If you wanted to gamble online, but you didn't have the money, Wirecard would lend it to you. If you wanted to buy stuff on a high-interest credit card, Wirecard would front you the cash. In the short term, this was great for business. They signed up millions of customers. Their balance sheet exploded. Their stock price soared. Wirecard became Germany's answer to PayPal, except with a twist. While PayPal facilitated transactions, Wirecard encouraged risky ones. While PayPal served reputable companies, Wirecard specialized in high-risk clients. And while PayPal grew steadily, Wirecard grew exponentially. In 2006, their revenue was $13 million. By 2018, it was over $2 billion. But behind this growth was a mountain of debt. Every loan to a customer meant another liability for Wirecard, and as they extended billions in cash advances, their liabilities piled higher and higher. By 2018, their total assets were only $9 billion, but their liabilities were over $40 billion. But investors didn't care. They kept loading up. Hedge funds bought their stock. Banks extended new credit lines. Everyone wanted a piece of the action, and the disaster just kept growing. In 2019, Wirecard entered Asian markets. They spent billions buying local companies. They expanded into mobile payments, online lending, even cryptocurrency. Their goal was simple. The more markets they entered, the more loans they could make, the more profits they could earn. In fact, at the peak, analysts estimated that 90% of Wirecard's revenue came from extending cash advances, and the secret sauce to this whole operation was leverage. Wirecard didn't use their own money to lend to customers. They borrowed money from banks and investors and lent it to their customers at a higher interest rate. It was pure financial engineering, and the profits were incredible. In 2017, their net income was $168 million. By 2018, it was almost $400 million. But underneath this growth was a ticking time bomb. For every dollar of revenue, Wirecard was taking on $5 in debt. By 2018, their debt-to-equity ratio was insane, 18-1. And all of this was being financed by investor money. Banks rolled over $30 billion in credit lines. Hedge funds bought up Wirecard stock. But the question was for how long? The reality was brutal. 75% of their revenue came from interest payments. So any rise in interest rates would cut straight into their profits. Any economic downturn would lead to more defaults. Any market move could trigger a margin call. And unfortunately, they didn't have much time before the music stopped. By 2018, investors started noticing something strange. Wirecard's balance sheet didn't add up. The company was claiming to have $1.9 billion in cash, but according to their own admission, half of that didn't exist. To make matters worse, their chief accounting officer was arrested. He admitted to inflating revenues by $3.2 billion. Suddenly, all of their growth evaporated. Analysts downgraded the stock. Investors started exiting. Creditors demanded repayment. And within months, Wirecard filed for bankruptcy. $30 billion vanished and Wall Street was left shocked. How did this happen? How could a company take on $30 billion in debt without anyone noticing? Or why didn't the auditors spot the fraud? Turns out they did. KPMG warned management about missing assets. But in their next report, they claimed everything was fine. The truth was greed. KPMG didn't want to lose a lucrative client, and Wirecard was willing to pay. They bribed auditors, manipulated reports, even forged documents. But perhaps the biggest red flag of all was their customers. If Wirecard was lending money to reputable companies, it wouldn't have been a problem, but their customer base was insane. 50% of their advances went to gambling sites, another 25% went to pornography. Only 25% went to legit businesses. And that raises a red flag. Why were they lending to such high-risk clients? What kind of due diligence did they do? And how could the banks not see this? Well, they did. Deutsche Bank flagged Wirecard's risky business model. Commerzbank called it a highly leveraged house of cards. But their concerns were drowned out by profits. From 2006 to 2018, Wirecard's revenue exploded from $13 million to $2 billion, and everyone wanted a piece of the action. Banks rolled over billions in loans. Investors bought up Wirecard stock and analysts praised its brilliant management. But the truth was leverage. Wirecard was never a $30 billion company. They were a payment firm with a few million in net income, but by borrowing money they pretended to be a giant. In reality, they were a house of cards, and when the music stopped, they collapsed. $30 billion vanished. The Wirecard scandal wasn't just about one company, it was about the system that allowed it. Banks, auditors, investors, analysts, they all turned a blind eye to the obvious. It proves greed can silence even the loudest alarms. Because in hindsight it wasn't hard to see the disaster coming.